Hey, everybody. Welcome back to today's Market Explained, a FourStar podcast series. I'm Brian Castle, your host, and I'm here with our provisional co-host. We have the return to today's Market Explained of Trader Jack Walsh. Jack, welcome back to the podcast.
Thanks, Brian. Great to be here.
Jack's got lots of experience in financial markets. He helps run one of the largest practices within FourStar, so he has a lot to offer. So, Jack, welcome. We call him Trader Jack. He's father of three, sports car enthusiast, and of course, a longtime trader at the Chicago Mercantile Exchange. So we're happy to have you, Jack.
Thanks, Brian. I'm looking forward. We got a lot of things to talk about today.
We do. And I'm the founder. I'm Brian Castle. I'm the founder and CEO of FourStar Wealth. I'm an Eagle Scout, National Boy Scout Foundation trustee, advisor to CEOs and insiders, chief dad to Quinn and Evan, and husband to the amazing Trippy. If you like what we're doing, folks, please give us a 5 out of 5. Tell your friends, forward them a copy of this show and have them listen. We'll be able to tell because we have everything up on a system where we can track who's watching and everything. So that's great. So we appreciate your support. Today, we're going to do our standard review. We're going to do markets, the economy, and what we see out there. Today's the 11th of July. And Jack, the positioning in the market has somewhat changed recently. So you have the numbers. Why don't you walk through the 6 major asset classes and where we stand today?
Sure. And the number one position is international equities. That's at 259. That's up 11. Number 2 is domestic equities. That's at 239. That's up 35. Number 3 is commodities, 188, down 11. Cash is in number 4, 176, down 18. We have currencies at 118, that's up 8. And fixed income at 117, down 2. And what I would note there, Bri, is, the Fed has had this inflation fight for well over a year and a half. And notice that commodities have started to fall. So it tells me that the Fed is having some success in its fight against inflation.
They are. And commodities are getting close to dipping from the 3rd position down to the 4th position, very close. But last year, Jack, the whole story was commodities. It was grains, it was energy and oil. Now all those prices have seemed to have normalized a little bit, and commodities are starting to fade. But they could come roaring back, Jack, couldn't they?
Yeah. Well, what we've been talking about on the investment committee is, the Fed has done a lot of work, and the target rate is between 5 and 5.25. They probably still have even more work to do. However, through that whole process, what they have done is they've stabilized the dollar somewhat, right? So commodities will rise and fall with the value of the reserve currency, which is the U.S. dollar. So we had a lot of success in one of our portfolios, that dynamic portfolio, betting on energy, betting on nickel, betting on grains. But the Fed has done a good job in managing expectations. They continue to, their mantra is higher for longer. We're getting close where real interest rates are going to go positive. And gosh, I don't think we've seen that in about 15, 20 years, right? And when I say real interest rates are going to go positive, meaning that short-term rates are actually going to be higher than the rate of inflation, right? So they've signaled to the market. The market has a 92% probability that they are going to go in July. A lot of people in the market suspect that they will go in September. The odds in the futures markets are only around 30 or 40%, but there's an awful lot of talk about them going in September. And I believe that the Fed does not want to signal a pause. A pause will cause the dollar to fall. People will start to speculate that the rate rising scenario is over, and they'll start to pile back into commodities. So that's why I think this higher for longer is still going to be with us for some time.
Could be. Well, Jack, how we played this whole market in 2022 and now into 23, we were maximum cash twice last year. And coming out of the fall of 2022, we were maximum cash. But now the markets have rallied a little bit, quite a bit in some cases. And there are 4 positions in our models to get back to fully invested. We're at position 3 now, so we're almost fully back invested. And the money that's was sitting in cash was earning 5%. So as folks sit in a 5% money market, they say, maybe I don't take as much risk, so it creates competition for the stock market. Now, Jack, you have some numbers on the concentration of this market. It's very, very concentrated in certain sectors.
Yes, Bryce. So this is just a comparison of June of 2023 versus June of 2015 and the basic top 10 holdings in the S&P. So in June of 2015, those top 10 holdings represented 17% of the S&P. And not shocked by this, Apple was at 3.9%. Microsoft was at 1.96%. Now, page forward to June of 2023, and those top 10 holdings are 31.72%. So double what the top 10 holdings were in 2015. Apple now is 7.5% of the S&P. Microsoft is 6.84%. So that's the type of concentrated stock rally that we've had. I mean, I remember when it bottomed and it started to take off, and it always starts out with short covering, right? And then there's going to be a story. The story this year has been AI, and we've got those concentrated positions, and it's really been difficult for anybody managing money to try and beat or stay with the index because it is so highly concentrated.
That's right. In fact, 30% of the S&P 500 stocks are still down for the year, yet the index is up about 14%. So it shows you there's some heavy concentration on the other side as well. And the Dow Jones Industrials are up a mere 2% for the year. So quite striking. So it's a very, very narrow market, and that leads to certain risks. Like, everybody who's been around a while might remember some of the tech crashes that we've had, 2000, 2001. We also had one last year, huge tech crash. So sometimes the tech stocks get too ahead of themselves. And so now we've had a big bounce back from last year's destructive tech market, but maybe that's gone too far again. And, with certain tech stocks up 100% and the index NASDAQ up 33%, maybe that's too far. And if you've been able to invest in that and do well, great. If you want to take some profits, maybe that'd be smart. But with the market so widely diverse in return, it's going to be hard to see that group continuing to go up forever.
Yeah. Well, one of the points that I would make here is it's the much talked about recession, right? We continue to push it back, right? Well, now they're talking about 2024, where you're really going to see a slowdown in growth. And that's going to get people talking about the projection on earnings. So one of the things that has happened this year, I remember at the beginning of the year, pretty much everybody said we're going to be down more in the beginning of the year, and we're going to have a second half rally. So we've got this end of first quarter, middle year rally, and it's created a wealth effect. People are feeling much better. Some of those tech names that were down 45, 50% have bounced back, big time. They're up 70, 75%. So what that has done has created a wealth effect, and we see it in travel. We see it in restaurants, right? So what the Fed is trying to do here is continue to have a stable dollar, raise rates without breaking something. However, the fear is with the slowdown in earnings and the concentration in the market, that with a couple more rate rises, there's a chance that they will break something. And that's why in interest rates, it's like a pool and a beach ball, all right? The Fed continues to say, we are going to be higher for longer. And then the 2-year note will spike up to as high as 5.10 in interest rate. 3 days later, it's at 4.83. The market continues to believe that out there in the future, something will break.
Yes. Well, and the Fed's going to keep pushing rates higher until something breaks. Last year, we saw Credit Suisse was on the ropes, and anyone who was around last year might remember that all of a sudden it was released that about $10 billion went out the back door of the Federal Reserve to country of Switzerland, that everyone was denying that Credit Suisse was in trouble. And sure enough, that's exactly what it was. And then it wasn't enough, and they had to take Credit Suisse out earlier this year and merge them with UBS because Credit Suisse was failing. We also saw the Japanese yen and the British pound go through periods of contagion where the currencies got real volatile and went down. Same thing with the British pound. So the Fed will and the central banks will keep raising rates until something is a problem. Then they work to patch it up and make it a little bit better. Partly is the bond market is significantly larger than the stock market. And so the bond market is really a major issue. The bond market and the stock market fell in 2022 together. That's the first time in American history that we've seen both the major bond indexes and the major stock indexes go down in 1 year together. So if they keep raising rates as they are now, that same phenomenon could happen if we have a reversal in the stock market this year. So we'll see how that plays out. Jack, you've got some other economic numbers on inflation in the dollar. Why don't we review those?
Sure. What the Fed is waiting for and what everybody is shocked by is how durable the job market is. So last week we saw ADP number come out at 497,000. That was a huge beat. And then 2 days later, we had the non-farm number come in at 209,000. Now, both of these numbers are seasonally adjusted. I would like to point out that the non-farm number had beat consensus 13 or 14 months in a row, which has never happened. And it has people scratching their head on how can some of these things that we've never seen happen. You would think from statistics that it's highly unlikely. But also the job market is a lagging indicator. Okay. So if we see unemployment spike and we start to see job losses, I would suspect that very soon thereafterwards, you're going to see the Fed cutting rates. So we have these statistics that are questioned, and it's not too far-fetched to see that you could go from the economy creating 209,000 jobs to all of a sudden a decrease of 150 or something like that.
Right. Well, and more numbers we're seeing, Jack, are plausibly impossible. Speaking of plausibly impossible numbers, the Chinese central bank is cutting rates. And, what does that tell you? The rest of the world is still raising rates to get rid of inflation. So China always talks about positive numbers. They never get us negative numbers. And we think we know why now. The Aussies and the Canadians paused. Then they kept raising rates again recently. The European Central Bank is hiking. Then the U.S. is on pause. Now we're going to raise again. As you said, they're going to go in July. They're going to go again, raising rates in September. So they're signaling 2 hikes. But the Fed is paused, but they're most likely going to raise again. And we're seeing some of the numbers, the CPI, core CPI, some of those numbers are easing a little bit, but they're still quite high. So the Fed cannot do anything to slow down their movement. If the market thinks they're going to stop raising rates, well, then they're going to react right away positively. They really want to slow things down. So they have to say they're going to continue to raise rates until at some point they don't. And they're going to have to speak hawkish instead of dovish. and make sure that everybody realizes they're going to keep raising rates until they get inflation down below 2%. A recent conversation that I was part of with a U.S. senator who had a private meeting with Jay Powell apparently is saying, yes, in private, the same thing he's saying in public, that they're going to be raising rates until inflation gets below 2%. So we got a little ways to go there, Jack, don't we?
Yeah, well, and Brian, I would also say that they want to stay out of politics. The Fed doesn't want to be political, right? So whatever they're going to do, they want to get it done this year, right? Because 2024 is a election year, and the Fed does not want to be meddling, right? They want to be out of that picture, right? So, yeah, they should definitely be done by the end of this year. We should see a slowing in 2024. And I suspect from the futures markets where I used to work in, that the Fed will be cutting rates by the second quarter of 2024.
Okay.
But in the meantime is what happens to the stock market. And, there's 10 times more money in fixed income than stocks. And I actually believe that the Fed would like to see the stock market ease off a little bit here, right? And have money move into fixed income, not just money markets. Those money markets that we are now getting 5.05 to 5.10, right? Money will flow in there short term, but they really want money back into the treasury market, right? So it's a very interesting time. I don't see the Fed cutting rates with the S&P at 4,400, right? That's why I suspect, not that the Fed is targeting asset prices. They know about the wealth effect. But I suspect that when they are cutting rates, the market will be at slightly lower levels.
Yes. Well, we'll see where it goes. And those who are scared of the stock market might want to take a little bit of profit here. But we're in a position where we're getting more and more positive signals. So we're probably we might get fully invested in the near term. But of course, we have a governor on our program that should things turn down, we very quickly move right back out and get into protection mode. That's the FourStar protection mode. So we'll see how things happen. We don't know what will happen, but we do have a plan. Once we see what happens, we know what we're going to do. So, Jack, why don't we move on to what we see out there? There's a number of things going on that I think affect the world economy, and just comments about things going on in the world we wanted to highlight. So George Soros, who is definitely a gentleman who is creating a lot of economic pressure in America, and he's very political, obviously, but he's speaking out about China recently, that they're facing an economic crisis. We talked about how China is lowering rates here when everyone else is raising rates. That means they've already been in really, really tough economic times, but they don't really tell us that. I mentioned how they create the CPI number in China. So everyone's got to come up with a positive number because everyone's boss wants a positive number, but many of the numbers are just outright fake. And so that's kind of how things are done there. Anyway, so Soros is saying that, obviously President Xi is looking for his legacy in China being in control of the world and, maybe becoming the leading economy in the world. But he says because of the pandemic and the Omicron and all the other things going on, they had a 3-year lockdown in China, that could be his undoing. The economy is very, very rough in China. And so that's why they're getting more and more aggressive with America. America has pulled back where, we used to export dramatic amounts of goods from China and import it to America. But so much of that has slowed down. We're moving more and more toward India. And meanwhile, while we're pulling back from fossil fuels and getting into solar and wind and other clean energy, China's ramping up their oil refineries while we're pulling back. So, there's a divergence in the world there as well. So the Chinese are clearly not on board with anything that America is doing. So the story of China is always fascinating. We talked about how, the CCP influences to make sure those Chinese numbers go really positive. The U.S. had a negative 32% quarter, the second quarter of 2020. That was the pandemic quarter, the first pandemic quarter. Yet the Chinese didn't show negative numbers. It's virtually almost impossible for China to not have shown negative numbers, but they still showed positive numbers. They were down a little bit from before to make it look good, but they were still positive. They've been locked down for 3 years, and so that must have affected them. Chinese leaders are now hosting Treasury Secretary Yellen, so they're still kind of apologizing and doing a lot of other things. So we'll see what happens. Many people are concerned that they believe our current president is compromised and is unwilling to go ahead and do much about China. Meanwhile, the Congress is fighting very hard to take some action on China. So China is going to be continuing the subject, Jack, for Americans and how we deal with China. They clearly want to be the world leader and take America off our post as the world leader. So they become more of an enemy and an adversary than an ally, is what it appears to be at this point. So, Jack, a couple other things too. We've seen some real changes in the economy, and then a couple things politically I wanted to mention. You saw how socially making very aggressive moves in advertising can change things. Bud Light lost 7.5% market share, and then they were replaced by Modelo as the number one beer, which was up 8% market share. Bud Light sales are down 30%, and they're no longer now a top 10 beer in America. For Bud Light to come from the number one beer all the way to not even in the top 10. So that just shows you how business decisions can create big economic decisions. And a lot of it's cultural. So that was, as bad or probably worse than the new Coke disaster, Jack, if you remember that in the 80s, right?
Yeah. Well, people are definitely voting with their pocketbook, and they're also voting with their feet, right? So people moving out of certain states and into other states, and people not buying products that they don't agree with. So it's really a divided country, but there are ways to fight back, right?
That's right. Well, and then economic outcomes can definitely be affected by the government. For the last 30 years, since Sandra Day O'Connor's comments after the court changed affirmative action first came in the 1960s, the court effectively ended affirmative action. So now, rather than racial preferences and using race as something that can make economic decisions, we're no longer allowed to do that, which is where things were. We're in a colorblind society. That's the way it always had been prior to affirmative action. And the court decided that we've now gotten to the point where affirmative action was more discriminatory to different groups, and they no longer wanted to do that. So affirmative action has effectively been ended. And also the federal courts have stepped in to force the Biden administration to stop censoring speech and controlling social media. The judge cited that the activity during the pandemic and the year after that by the Biden administration was probably the largest theft of free speech in American history, and they may have violated the First Amendment. So why that's important is that did affect economic decisions where people were making comments about the pandemic, making comments about all things regarding the pandemic, with drugs, different methods for solving the pandemic, and they basically censored any speech they didn't like. The Supreme Court finally said, or the federal court, not Supreme Court, federal courts finally said, no more of that. We're going to have free speech. That's an element of economic growth as well, is to have free speech. And so now, obviously the Biden administration is fighting it, but the court has spoken. Lastly, I did want to point out, Jack, there's a big population trend that's been going on for a long time, from the northern states to the southern states, from colder climates to warmer climates. And the South has become a major economic engine as a result of that. So when you look at the major states in the North and the East Coast and then the South, 26% of all the wealth used to be in the North, and then only about 19% in the South. This is about 30 years ago. That whole equation has changed. It's now 26% of all the wealth is in the southern states and only 19% in the northern states. The southern states being Florida, Georgia, North Carolina, South Carolina, Tennessee, and Texas. Those are the strongest economic growth states in the South. And then the weak states, New York, Connecticut, Massachusetts, Pennsylvania, New Jersey, and Maryland. And so they've seen their wealth and their population go down. Now, it used to be just retirees that were going to the South, but now it's all demographics and seemingly endless set of businesses going from northern states to southern states. 2020, however, was the tipping point where states with few taxes and then also less lockdowns and less severe activity toward the pandemic, that activity caused people to want to move, and they brought their money with them. So the wealth transfer, Jack, between 2020 and 2021, southern states gained over $100 billion of new wealth from people that came there. And the northeastern states lost $60 billion in assets. So it's been quite a striking move. So now the southern states are the economic engine of America, no longer New York, Connecticut, Maryland, and DC, and all those states around the north. Isn't that interesting?
It makes perfect sense to me. We saw Ken Griffin at Citadel move his entire operation out of Chicago down to Miami. Yeah, I mean that's part of the digital economy, right? Is
Yes.
that you don't have to be in a certain hub, right? I mean, we used to have, the Chicago Mercantile Exchange, the Chicago Board of Trade, right? Everything is now digital. So, and it just goes back to people voting with their feet. Mm-hmm.
Well, and we're hearing proposals now in Chicago from the new mayor about transaction taxes and a whole series of other taxes. And the fear, of course, is if any of that happens, those businesses will continue to leave. We could see the Chicago Mercantile Exchange become the Miami Mercantile Exchange, or something thereabouts. The Houston Mercantile Exchange. So they have to be very careful, policymakers, in what they do, because it definitely does affect commerce. It does affect people's decisions. And I remember in the beginning of the MBA program that I went through at University of Chicago, the first comment when we walked in the room was, we're going to study incentives for the next 2 years. And life is all about incentives. And you create the right incentives, people do the right thing. Create the wrong incentives, they also might just do the wrong thing. And so that's why it's important that the policymakers be very, very smart and judicious about how they tax the public. So
I agree.
I think we're mostly done, Jack. I just wanted to highlight everybody. There's a number of blog posts that are out there that might be interesting to see on the FourStarWealth.com site for the leadership matrix, the hydrogen, drilling now, sustainable energy. If we're able to make hydrogen a sustainable energy, that could change everything. Fossil fuels could change everything from wind, solar, over to hydrogen. So it's very, very fascinating. So a great article on that. Then also just a behavioral finance article we put out about, does it make sense on how people make decisions? Like, does it make sense to take the $300 stipend from the airline and wait to take the later flight? Or does it make sense to not do that? And so there's a lot of ways people make decisions economically, and some of it's rational and some of it's not rational. And that's in the whole department of, what is behavioral economics? How people make decisions really affects their economic outcomes. Lastly, there's a couple of podcast interviews I want to highlight. One is already out and one is coming. Patty Arviello, who was a leader of a very successful mortgage business in Nevada and California. Mortgage business is down like 80% with transactions slower, interest rates higher, and then refinancing basically dead. So Patty has some very interesting comments about the mortgage industry and how they're doing and how they're managing through it. So that'd be a good one to listen to. And then coming up in the next few weeks, we're going to be interviewing Andy Salk. And Andy is the president of First Eagle Bank in Chicago, which is a small community bank. But fractional banking is in question here. We've seen so many big banks that failed in the last year because interest rates are tighter and tighter. And so how do we manage fractional banking? We're going to hear from Andy Salk about how he does it and how his bank is doing fine and how many of the small community banks are doing just fine and not worried about interest rates going higher. So anyway, those are great interviews. Jack, we covered a lot here. I think we're pretty much done for the day, huh?
Thanks, Brian. It's been my pleasure. I always enjoy it.
Thanks for being with us, Jack. And thanks everybody else for joining us on today's Market Explained. We'll be back with that Andy Salk interview. We'll also be back with another episode talking more about the economy. We'll see what happens if the Fed raises rates here and what the economy does, what the market does. And so we'll leave it there for today. Thanks for joining us, everybody. We'll be back soon with another, what we think is great episode of today's Market Explained, a 4-Star media event and podcast. Thanks, everybody. Bye-bye now.
Thanks.